You know, every single business out there is chasing the same thing, growth. But what happens when the very thing that fuels your growth, actually making a sale, isn't as simple as a customer just handing you cash? Well, that's what we're going to dive into. So here's the big question, right? What do you do when potential customers want your product, but they just don't have the cash on hand at that exact moment? This is a classic business problem, and honestly, how you solve it can make or break your entire company. The go-to answer, more often than not, is to sell on credit. You let the customer take your product or service right now, and they promise to pay you later. Now, this can absolutely unlock a ton of growth, but it also opens up a whole new can of worms, a new world of risk. All of a sudden, you're not just selling something, you're managing a promise. And that really is the core of it all. At its heart, a credit sale isn't just a simple transaction. It's you accepting a promise that you will get paid sometime in the future. Think about it this way. You're basically acting like a small bank for your customers, only you're not charging them interest. You are fronting them all the value, trusting that they're going to make good on their promise to pay you back. It's a really powerful way to build relationships and, of course, to close more deals. So, in the world of finance and accounting, these promises aren't just left floating around in the air. Nope. They have a specific official name. And that name is accounts receivable. It's the formal term for the money your customers owe you. But here's the really crucial part. Receivables are considered assets. That means they represent real value that belongs to your company, even before you have that cash in hand. And this isn't just some accounting trick. It means this future cash is so real that companies can often use their receivables as collateral to get a loan from a bank. So when you think about this asset, what is it really? Well, it's a legal claim to future cash. It's a direct investment you're making in your customers. And it's a vital, absolutely critical part of the working capital you need to run your business day in and day out. So let's boil it all down. Accounts receivable is simply the money you're waiting on from sales you've already made. It's an asset, and it's a promise of cash that's coming your way soon. Okay, so just having these promises on the books isn't enough. You have to actively manage them to make sure they actually turn into cold, hard cash in your bank account. And this right here perfectly illustrates the goal. You want to use credit to drive as many sales as you possibly can, but you have to be smart about it, right? You've got to minimize that risk that some customers just never pay you back. It's a really delicate balance between opportunity and risk. And that strategic process, that balancing act, has a name. It's called Receivables Management, and it's not just about chasing down late payments. It's a whole system for handling credit sales from the very beginning to the very end. So what's the bottom line here? Good receivables management is all about your cash flow. It is the process that turns those promises on your balance sheet into the real cash you need to pay your bills, pay your people, and, of course, grow the business. This brings us right to the core challenge. Offering credit is a constant trade-off. It's a true balancing act between the rewards you can get and the risks you might have to face. I mean, just look at this breakdown. On one side, offering credit can skyrocket your sales, build incredible customer loyalty, and give you a huge leg up on competitors who demand cash up front. But on the other side, you're facing the very real risk of bad debts, customers who just don't pay. You also have to deal with delayed cash flow and all the admin costs of managing the whole thing. So how do you control this balancing act? You don't just wing it. You do it with a formal, written-down tool. And that tool is called a credit policy. This is your rulebook. A really solid credit policy is built on three main pillars. First up, you have credit standards. This is your who. Who gets credit? You might run a credit check on new clients, or maybe you only offer it to customers with a great payment history. Second, you have credit terms. These are the rules of the game. A classic example you'll see is 210 net 30, which means customers get a 2% discount if they pay in 10 days, otherwise the full amount is due in 30. And third, collection efforts. This is your what-if plan. What if they're late? It could be an automatic email reminder on day 31, a phone call at day 45, and a clear process from there. So, the crucial takeaway here is this. Your credit policy is where your big ambition to grow sales meets the financial discipline you need to stay healthy. It is the playbook for turning those promises into actual profit. All right, we have covered a ton of ground, from what receivables even are to the whole strategy behind managing them. So let's bring it all together with the single most important takeaway. If you remember just one thing from this explainer, please let it be this. Receivables management is not some boring back-office accounting task. It is a high-level strategic function. When you do it right, it lets you safely and intelligently use credit as rocket fuel to grow your business way faster than you ever could with cash-only sales. And that leaves us with one last question for you to think about. Take a hard look at how your business, or any business you know for that matter, handles credit. Is that process a finely tuned engine for growth, or is it an unmanaged risk that's just waiting to cause a big problem? Because the answer to that question makes all the difference.